My name's Fernandes. I'm a partner at Linklaters, which is a global law firm. I'm a partner in the financial services regulatory practice. We have about 10 partners and 50-odd associates, and we spend almost all of our time advising clients on reg change, principally. And MIFID and MIFIA have been, for probably the last 12 months, one of the biggest things that we've been advising a number of our investment banking clients on. And when I was asked to come along today and speak and give an overview for 15 minutes, I realized that was an incredibly daunting task, because the breadth and scale of the change is so enormous that all you can possibly do in 15 minutes is really scratch the surface. But that's what I'll try and do, and then I'll try and relate it back to how this may be relevant to you in the audience as effectively end users and counterparties to the banks. So I'll talk a little bit about what it is, critically what the timeline is, where we are in the process, so you can sort of understand what's happened and what is about to happen. I'll give you an overview on the areas that the banks principally are being impacted in relation to, and then some points to note for you, as I said, effectively as end users. Right, so what is it? We already have a MIFID directive. It's the core bit of financial services law that authorizes intermediaries to do what they do in the capital markets, permits them to provide those services cross-border within Europe, which is why in the earlier talk we had some questions raised around the extent of the impact on Brexit, principally on banks. And when banks, certainly those operating out of London, are assessing the impact on them, one of the things that they are grappling with is what does the removal of the passporting rights under MIFID do for them, and how else can they continue to service clients in Europe without the benefit of that passport. So it regulates the intermediaries, imposes significant conduct obligations on them, provides them with their core licensing rights, but also impacts the markets in which they operate. And principally in MIFID 1 it focused on the equities markets, but a heavy degree of regulation on the equities markets, created a set of rules around transparency, pre-trade, post-trade, transaction reporting, which brought a degree of fairness, if you like, in the eyes of regulators to the equities markets. So MIFID 1 implemented in 2007, successful. We move along, we have the financial crisis, and like all things, that created an excuse, a drive for regulators to revisit MIFID 1 and ask themselves what else can be done, how can it be upgraded to potentially further improve the markets, and address some of the things that caused the crisis and some of the things that were exacerbated by the crisis. So there are four principal things that regulators sought to achieve in revising or reviewing MIFID 1. One was to have a look at the structure that was put in place for equities to create what they thought was a very fair and transparent and liquid market, and to say, let's unroll that structure to all asset classes. So there's going to be an increase in transparency across all asset classes, replicating the equities markets. I think that's the first big drive or first big consequence. The second is to identify that markets have become increasingly electronic. That obviously creates risks in the regulators' eyes. We had the famous flash crash back in 2010. We had purportedly exacerbated decline in the value of the sterling recently, also attributed in part to algorithmic trading. So I think regulators have acknowledged that this is potentially a risk for markets, that it may compromise the fairness of the markets, and so we're going to see a whole bunch of new requirements around firms who employ algorithmic trading and the intermediaries that either do it or facilitate it. Thirdly, there's going to be more and more information provided to clients, and that's perhaps something that's more relevant to you. There's a feeling that intermediaries potentially stand to benefit in their relationship with clients because of their information power and the lack of transparency in the way they price things, and so there's going to be more and more obligations on them to provide information to you, including breaking down costs and charges in more detail. And finally, there's going to be a whole lot more reporting, both public and by intermediaries and firms, to regulators, which is a consistent theme we've seen in all regulatory reform following the crisis. So those are the four sorts of drivers that encouraged regulators to look at MIFID 1 and seek to improve it through what we're looking at now. So where do we stand in the process? This is an incredibly busy slide. I'm not purporting at all that either you can read it or can take away the detail. But there's two things I'll point out to you. At the very left-hand side is when this all started back in 2010. So in December 2010, the European Commission made their initial proposals for radical reform. We've marched along. We'll see about 3/4 of the way across on the right-hand side, we are here. And when implementation will take place right at the end on the 3rd of January 2018. So that's a 7-year process. For those of you who are familiar with European law and the lawmaking process, you'll know that it's incredibly complicated. But what made this so long, and is still making it long, is that the law itself is incredibly complicated. So what I outlined to you as the 4 overarching changes or drivers, we're talking about that much law, a whole lot of detail. Of the 50, 60 people in my team, 20 of whom focus almost entirely on MIFID, and we've had to split that up between them as to allow people to develop expertise in certain areas. There is no one person alive that knows this all, back to front. And this timeline is designed really to show you how complicated and time-consuming the process of making the law has been. We're nearing the end, but I think you'll find in 2017 is when a number of the banks escalate their implementation processes, and you'll start to see as end users greater correspondence from them with you to try and get ready for launch at the beginning of 2018. The bottom left-hand side there, I've also just tried to give you a feeling for the scale of the change just in raw statistical terms. So European law has 3 levels. There's level 1, there's the core text. Level 2 measures, which is all the detail, the nuts and bolts about how the high-level requirements are going to work. And level 3 is sort of guidance to explain to the industry how to approach the more complicated areas. And we'll see there that there are 47 level 2 measures. Each one of those is a regulation unto itself, and some of them are quite long. So all in all, a significant piece of legislative change, taking a long time from origination to implementation, and a really material deal for the banks that you'll interact with and who service you. Right, so this is an overview of the areas that are going to change for them, not all of which will directly impact you. We tried to bucket them into certain areas. So market structure reforms, various subcategories within there, but in effect, what we're going to see is a movement of trading towards certain key venues. There are 3 or 4 categories of trading venues that are defined under the regulation, the directive and the regulation. And the idea of defining them and giving more importance to them, imposing more obligations on them, is that more and more trading in all of the asset classes, tradable asset classes, eventually moves towards those venues. We've mentioned a little bit, I mentioned a bit earlier about automated trading and high-frequency trading, a greater degree of prescription around how that can happen and the controls that firms need to implement in order to deploy that. Pre- and post-trade transparency, that links with the market structure that's being put in place. So there are significant obligations in all of those trading venues and the intermediaries that will facilitate trading on them to be transparent pre-trade and post-trade. Now that's a significant change in a number of the non-equities markets, and it remains to be seen exactly how that is going to work in practice. There's an enormous amount of prescription around the rules, but and firms are currently figuring out how practically to comply with that, but how it actually works, people have asked, remains to be seen. And we're going to see in January, and no doubt for a period after January 2018, that emerge with the passage of time. Transaction reporting, more significant obligations to report transactions to regulators so that they can, in theory, monitor what's going on in the market, and a huge amount of increased detail as to what needs to go into that. So when trading with your counterparties, you'll want to make sure and be clear about who the obligation falls on. Are they going to discharge that for you? Do you need to delegate it to them? What arrangements need to be put in place to facilitate that to the extent that you have your own obligations? Investor protection, a number of those measures are things you will benefit from as clients of banks. In effect, I think what you'll see leading up to January 2018 and thereafter is more paperwork, more information. And I think the obligation will be on you just to make sure you're understanding what you're being provided with, and the context in which you're being provided with it, what you need to sign, and don't be afraid to ask the banks what it's about. At the end of the day, this information is being mandated to be provided to you because it's being deemed to be of benefit to you. So try and utilize it and make sure you understand it and ask if you're not sure. Best execution is another aspect of investor protection I think may be relevant to you. So this is the obligation on firms when they are trading effectively with clients to ensure that clients get speedy execution, the best price available, and the best service available. It's famously undefined, but what MIFID2 is going to do is impose more obligations on venues and banks to publish where they're executing client trades and at what prices. And in theory, that volume of information coming out into the market will provide clients with the opportunity to scour that and identify whether they're, and try and stress test whether in fact being provided with the best service that the banks are suggesting they're offering them. So the volume of information out there will help you choose your counterparties in a more sophisticated way, but clearly it's going to take some time and effort for you to adjust to that information and understand how best to use it, but that's certainly the theory behind it. Right, key points to note. How am I doing time-wise? Some of these I've spoken about already, consequences for you as end users. But in many senses, I think the real benefit for you as end users will be indirect, and it's not yet possible or clear how those indirect consequences will emerge. The direct consequences of all of this is principally falling on the intermediary community, and as I said, they're in the throes of getting ready for all of that. So transparency, potentially much better information for you around pricing, investor protection we've touched on, execution, best execution and the information around that, and putting you in a better place to assess the services provided by your clients. And the emergence of new trading venues, I think, is going to be a big one and an indirect consequence. Having those venues being categorized more clearly, and a range of tangential obligations encouraging trading on those venues, I think we're going to start to see in the non-equity space certainly a proliferation of those venues, much like we did see from MIFID 1 in relation to equities markets.